Here's a puzzle that's popping up all over Canada, and maybe it's one you've thought about too. How on earth can a small condo, with shared walls and all those rules, actually end up costing you more every single month than a whole house? It just doesn't feel right, does it? Well, let's pull back the curtain and see how this illusion really works.
So when you first look at it, the choice seems super straightforward, right? On one side, you've got the condo. Sure, shared walls, sure, and those monthly fees, but hey, less maintenance. On the other side, the house. All your own space, way more freedom, but every single bit of upkeep is on you. That's the basic trade-off everyone thinks they're making. Which brings us right back to that big question. A house just seems to offer so much more freedom. So how is it even possible that a condo could hit your wallet harder every month? Let's start digging into this illusion.
Okay, so let's start with a big sales pitch. The core idea that condos are your most affordable ticket into the Canadian housing market. But as we're about to see, believing that without asking a few more questions can be a really dangerous oversimplification.
And this is really where the illusion gets its hooks in you. You see that lower sticker price, and that immediately means you need a smaller down payment. If you're a first-time buyer, that looks like the absolute perfect way to get your foot in the door and start building some equity. It's a very, very easy sell.
And if you just look at the initial numbers, the math seems to prove it, doesn't it? In this example, the condo's mortgage and property tax come out to $2,300 a month. The house? It's over $500 more. Seems like a no-brainer. The condo is cheaper, right? Well, not so fast. Because this is where we get to the big reveal. We're about to introduce the one variable that doesn't just change the equation, it completely flips it on its head. This is the number that shows you the true ongoing costs of ownership.
I am, of course, talking about condo fees. Now, these are mandatory. They cover all the shared stuff, the lobby, the gym, the elevators, and they're supposed to put money into the building's savings account, what's called the reserve fund. But here's the absolute key, and you really got to get this. Unlike your mortgage, this money builds you zero equity. It is a pure expense. It's just gone.
And we are not talking about pocket change here. In a lot of Canadian cities, it is not remotely strange to see condo fees hitting $800 a month, and sometimes they go even higher. A payment that big changes the entire financial picture.
So, let's plug that $800 condo fee back into our comparison. All of a sudden, the condo's total monthly cost shoots up to $3,100. It is now $250 more expensive every single month than the house. And just like that, poof, the affordability illusion is shattered. And here's the real kicker. While you're working your tail off to pay down your mortgage principal, this other cost never, ever goes away. In fact, it's pretty much designed to go up. You've got inflation pushing up the cost of everything, the building itself is getting older and needs more repairs, building insurance is going through the roof, and new safety rules can add huge expenses. It's a one-way street, and it only goes up. Okay, so if you thought predictable rising fees were bad, we're now moving into territory that's, well, a lot scarier. We're going from the costs you know about to the unpredictable risks that can be financially devastating.
See, a condo isn't just a home. It's what you call a shared risk environment. One person's dishwasher floods their kitchen or a small fire starts in a single unit. Well, that can lead to a massive insurance claim against the entire building. And when that happens, the building's insurance premiums can absolutely skyrocket for every single owner, passed on to you through, you guessed it, even higher condo fees. But the real wild card, the thing that keeps savvy condo owners up at night, is something called a special assessment. This is basically a surprise bill that gets slapped on every owner when the building's savings account, the reserve fund, can't cover a major repair. We're talking elevators, garage repairs, new balconies. And these bills, they are mandatory, they are immediate, and they can be absolutely crippling.
So all of this, the fees, the shared risk, the special assessments, it all points to one huge fundamental problem, a blind spot right in the heart of the Canadian mortgage system that leaves thousands of buyers exposed, and most of them don't even know it. This right here reveals the central flaw. In Canada, we have a very tough borrower stress test. The banks do a deep dive to make sure that you, personally, can handle higher interest rates. But what we don't have is a housing stress test. Nobody, and I mean nobody, is checking if the building you're buying into is financially healthy enough to survive inflation and just plain getting older. The system basically just ignores the financial health of the asset itself. It doesn't stress test the assumptions made in the reserve fund study. It doesn't check if the building's insurance policy is even sustainable long-term, and it completely overlooks the crushing one-two punch of soaring condo fees hitting you at the exact same time your mortgage is up for renewal at a much higher rate. People pass their personal stress test only to get financially squeezed by the building's problems.
Okay, so that's the system. It's flawed, but that doesn't mean you're helpless. Let's pivot from the problem to the solution. Think of this as your personal investigator's checklist to use before you even think about buying.
First things first, you have to do a complete mindset shift. The most common question buyers ask their realtor is, how low are the fees? That is the wrong question. In fact, it's the amateur question. The right question, the pro question is this building financially healthy? Because a super low fee isn't always a good deal. Often, it's a huge red flag that big bills are just being kicked down the road.
Next, you need a hard number, something tangible you can work with. You need to ask, what is the total amount in the reserve fund? Then you divide that number by the number of units in the building. This simple calculation gives you the reserve fund per unit, and it's a fantastic snapshot of the building's real financial cushion.
So, what's a good number? Well, these are some solid rules of thumb for Canada. If that reserve fund per unit is under $5,000, you are looking at a high-risk situation. 5 to 15 grand is borderline. Really, you want to see a number up in that $15,000, $20,000, $25,000 range or higher. That proves the building is actually planning for the future, not just hoping for the best.
And finally, question number 3 is all about connecting the dots. You have to look at all the pieces together. A 25-year-old building that's boasting about its rock-bottom condo fees and has a tiny little reserve fund? That is not a bargain. That's a ticking time bomb of deferred maintenance and future special assessments. You have to ask yourself, does the age, the fee, and the savings actually make sense together? If they don't, you walk away.
So, as you're out there weighing your options, just remember this. The true cost of a home isn't always on the price tag or in the square footage. It's often buried in the unseen compounding costs. Because in today's market, the most expensive homes aren't always the ones with the biggest yards. Sometimes they're the ones with elevators.